If you're an incorporated business owner, you've probably heard the term RDTOH, Refundable Dividend Tax on Hand. At a high level, RDTOH is a tracking account used by the Canada Revenue Agency. It keeps records of certain corporate taxes that are refundable, but only after your corporation pays a taxable dividend to you as a shareholder. In other words, some taxes your corporation pays are not meant to be permanent. They're meant to be temporarily held until money is eventually taken out of the company. Prior to 2019, corporations only had one RDTOH account. But as CRA tightened the rules around passive investment income inside corporations, this changed. Today, corporations have two notional RDTOH accounts. One is the eligible RDTOH, second is non-eligible RDTOH. These two accounts exist to ensure that the type of dividend your corporation pays aligns with how the investment income was earned and taxed. This change was part of a broader effort by the CRA to reinforce tax integration. Integration is the idea that there should be no material tax advantage to earning income personally versus earning it through a corporation and paying it out later. To do this, the CRA uses several mechanisms: different tax rates, dividend gross-ups, credits, and refundable taxes. RDTOH is one of those mechanisms. There are two main situations where refundable taxes are created inside a corporation. First would be the passive investment income, Part 1 tax. When a corporation earns interest income, foreign dividends, rent, royalties, or taxable capital gains, it pays tax at a very high corporate rate, equal to 50.67%. A portion of that tax, 30.67%, is refundable, but only when a taxable dividend is paid. These refundable amounts are tracked in the non-eligible RDTOH account. Think of this as the CRA saying, "We'll give you some of this tax back, but only once money actually flows to you personally." The second part is the Canadian dividend income, Part 4 tax. When a corporation earns eligible Canadian dividends from public companies, CRA applies Part 4 tax. This tax is also fully refundable, and it accumulates in the eligible RDTOH account. Again, no refund until a dividend is paid to the shareholder. Eligible dividends can only trigger refunds from eligible RDTOH. Non-eligible dividends must first draw refunds from non-eligible RDTOH. CRA's rules are very specific about which refunds come first and in what order. This prevents corporations from paying the wrong type of dividend to access refunds more favorably. RDTOH doesn't change whether tax is paid. It affects when tax is returned to the corporation. If dividends aren't planned properly, refunds can be delayed, cash flow inside the corporation can be restricted, the wrong type of dividend can be paid at the wrong time. For corporations with investment holding companies, portfolio income, or multiple entities, this becomes especially important. This is why we always encourage business owners to look at dividend planning, corporate investments, and personal tax strategy together, not in isolation. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.